30% of millennials and 60% of Gen Z have not started saving for retirement. And honestly, I get it. There's a huge lack of financial literacy in our country. Schools just don't do a good job at teaching young adults basic personal finance skills or how to plan for the future. Welcome to Market 101, where we give you the basics on finance, economics, and of course, the market. If this sounds like the kind of show that you need in your life, go ahead and subscribe and join the Market Moment community for our weekly podcast episodes on trending market news. Also, data briefs breaking down investing and these Market 101s. In this episode, I'm going over different retirement plans like 401ks, IRAs, Roths, employer matches, defining risk tolerance, and hopefully empowering you to take control of your future by starting today. 401ks are an employer-sponsored retirement account. Most companies offer these plans, but if you work for a small business, they might not. If you are offered a 401k, use it. You will designate a percent or dollar amount to contribute from each paycheck, and it will be automatically deducted before you receive your check. As your income increases above your living needs, you should increase the amount you are contributing to the 401k. Some plans will have an automated option that increases the contribution by 1% each year. By gradually increasing your contribution, you won't notice it. It's in the background doing its thing. Your account won't be invested based on the plan's preset options, so it's a good idea to check that yours is invested in the best way for you. Not every business or company will offer an employer match, but many do for retirement accounts like 401ks, 403bs, 457, and even more. Your employer might match your contribution up to a certain percentage, often 3 or 6%. It is important that you get the full match from your employer because this is basically free money being put towards your retirement that you wouldn't receive if you weren't contributing. An IRA is a retirement account like the 401k, but it's not employer sponsored. You could open an IRA through a financial platform or firm at any point in your life if you have earned income. Since it's not an employer-sponsored plan, there is no match to your contributions. But with an IRA, you have the full freedom with the investments and often can pay less in fees. Both an IRA and 401k are tax deferred, so you don't pay any taxes on the money you put in until you take it out. And you shouldn't take it out until you're at least 59 and a half. If you do, you will incur a 10% penalty for taking it out early. Ouch! And hey, if you're liking this video, leave us a like. It helps us know that we're doing a good job making financial education more accessible and easier to understand. There are actually two types of IRAs, Roth and traditional. The difference between a Roth IRA and a traditional IRA is when the taxes are taken. With a traditional IRA, the taxes are deferred, meaning you pay the taxes on the money and the growth of that money when it's time to take it out. But with a Roth IRA, your money is taxed before contributing, and because of that, it won't be taxed later at retirement, nor will the growth. That's why a lot of people recommend Roth IRAs because of these tax benefits. Now I want to define something called risk tolerance, because depending on your retirement plan, you may or may not take a risk assessment, which helps your financial planner know how you want your money to be invested. And if you don't take a risk assessment, it is still important to check in and see how your investments are being invested. Your risk tolerance is the amount of risk you are willing to accept. The longer time frame you have until retirement, your risk tolerance could and likely should be more aggressive. This is because you have the time to recover from market volatility.
Let's look at the S&P 500, which is an index of 500 largest publicly traded companies, and it's a good benchmark for how the United States market is doing. This chart illustrates the benefit of time in the market versus timing the market. If you invested $100 on November 2005 and just let it ride the volatility of the market for 10 years, you would end up with $173. This line shows what your return would have been if you tried to time the market or even got scared and sold out. If you started with the same $100 in 2005, but were not invested on the 10 single best earning days in the market, only 10 days not invested, you cut your returns by 66%, leaving you with $125 instead of $173. Now imagine if your initial investment had been $10,000 or $100,000. The loss of potential earnings would be drastic.
So by starting young and investing in the market, you have more time on your side to ride out the highs and lows, Plus, you have the benefits of more compound interest. There will be years when the market will be negative, but it's important to remember that you're in it for the long run. The market goes up and down. Hold on to your hat. But if you're older and you have less time on your side, your risk tolerance will look a little different. You don't have the time to ride out the lows. So if you're invested too aggressively, the lows could be devastating to your retirement. And that's why it's important to look at your specific financial situation, your time frame, your goals, and realize that the market is indeed risky. If you want to see an example of how patience, time, and compound interest can do its thing, here's Eli's data brief on how getting from 0 to 100,000 takes as much time as going from 500,000 to $1 million. All the more reason why it's important to start now.